Hey everybody, Chuck Barone here. It is Wednesday, October the 4th, 2023. Midway through another week of crazy, man. These markets don't know what in the heck they're going, which way they're going. Just one day up, the next day down, and up, down, all around, crazy. No real direction in these markets. The market can't figure out whether to be optimistic or worried. It's comical watching it, guys. It really is. But before I get rolling again, let me welcome everybody to the show. And as always, thank you guys for your support. We appreciate you guys watching these videos, your questions and comments, likes, everything you guys do for us every day, man. It does not go unnoticed. We appreciate it. All right, so let's talk about these markets today. After slumping pretty bad for about the last week or so, markets rally a little bit today. Stocks up across the board. You have the Dow gaining 127 points, sitting at 33,129. You got the NASDAQ rallies 176 points, 13,236. And the S&P, the broader market, rallies 34 points, 4,263 on the S&P. So a good day for the markets, all the way across the board. Looked like a lot of green today for a change. Was nice. No real reason for the markets to rally up. I guess the fear of this JOLTS report yesterday, getting brushed off. So the market's going to rally. The bond market rallies a little bit too. I guess it can't go straight down, right? So the 10-year today rallies, falling 7 basis points, sitting at 4.73%. The 2-year falls 9 basis points, sitting at 5.05%. So this inversion, and we're going to talk about this here, this inversion now narrowing down just 32 basis points. And in July, it was 108 basis points. So it's really kind of compacting down now. I'm going to talk about some of what that means here in the comments. The dollar today down small, but did fall under 107, sitting 106.72, still super strong, but coming down a little bit, which is something that we need to see for those of us that are fans of gold and silver. Although even with the dollar coming down today, gold and silver, no fight today, just a bad day. Gold falls $1.90 per ounce, $1,820.70 for an ounce of gold. Silver falls 13 cents, under $21, sitting $20.99 for an ounce of silver. Metals have been under pretty big pressure with the dollar. I think metals, or especially silver, is something that a lot of people who are not real big investors, stock market investors, might have some stashes and maybe liquidating some of it to pay bills and, deal with prices and inflation. But gold and silver looking for a rally here. Let's see what happens with the dollar. As the dollar comes down, I think you're going to see a gold and silver take off. Oil today, wow, bad day for the oil fund, oil people. Oil down over 5% today, falling $4.53 per barrel, sitting at $84.70. I'm not going to get excited about it. I'm going to wait to see a confirmation of prices in oil coming down. I'll be looking to the gas station I go to fill my car up, see if gas prices are reflecting this come down in oil. I'm guessing they're probably not gonna. Bitcoin today comes up $357. Bitcoin sitting at 27,708. I think there's going to be a rally coming in Bitcoin. SEC been losing some lawsuits trying to hold Bitcoin back. Some of these ETFs that want to get started with Bitcoin. I think, Bitcoin has kind of just been smoldering here for, it seems like, forever. I think that, we're going to find a reason to rally in Bitcoin. If some of these ETFs get off the ground, it's going to increase demand for the product. So let's see. Bitcoin, 27,708. All right, so let's talk a little commentary here today. Let's talk about this JOLTS report yesterday. That job openings number that the JOLTS showed spooked Wall Street like crazy yesterday. They were expecting 8.9 million job openings, got 9.6 million. That's a big difference, 700,000 jobs. So yesterday the market freaked out about it. Today, not so much. But the market is now pricing in a 50-50 chance of another rate hike this year. Remember, I was laughing. I said the market is so discounting everything. The market basically was pricing in a 0% chance, 0% chance that rates would go up again this year. We're looking for rate cuts next year. That's already been getting all chopped up. Now, I told you guys, I really thought we were going to get that bump in rates last month. I thought if you're going to raise rates anyway and you know the numbers are not going your way, why wait? If you know you're going to raise rates, just do it, man. Pull the trigger, rip the Band-Aid off, whatever it is. Get it over with. Well, we didn't, but now it looks like that November-December meeting is going to be when they're going to pull the trigger on it. I've told you guys, and we talked about this, the Fed has had a target rate of 5.6, or what do they call it? Their terminal rate is the word they use, meaning it's not going to stimulate borrowing and it's not going to hinder borrowing. It's like a neutral rate that it's neither positive or negative. Now, I'm not sure if that's actually true, okay? But it looks like, one more rate increase. We're sitting at 5.35% now. If we get a 25%, quarter point increase, 0.25, that'll put us right at their target at 5.6. So I've really been believing this is going to happen, and I still do before the end of the year. But the question is going to be, will borrowers, will debtors still maintain this appetite for debt? Let's face it, man, people, they're adding debt like crazy. $10.5 billion just last month. They're expecting $11.5 billion this month. So borrowers, consumers, have not really been shying away from debt. I think it's kind of like become something now that's really lifestyle. It's like ingrained. It's just normal. But let's just see how these same people who are willing to borrow money react when it's time to start writing some big checks, big payments. Nothing's going to slow down debtors from borrowing money than when it's time to start paying it back. And these new payments, money they're borrowing now, are going to have pretty high rates. They said the average credit card rate is higher than 25%. And those people with the off-brand, so to speak, they're paying more than that, right? And you got student loans resuming, record levels of debt, and on and on and on it goes. No savings. So let's see if this slows down, this consumer borrowing binge. I think that would really freak Wall Street out. Wall Street already concerned. The VIX today up above 20. Oh my! Temporarily, I don't think it finished there, but the market's starting to understand there's going to be some volatility. It's fear and greed, man. Those are the two. Right now, it looks like today was more of a greed day, I guess, with people buying. But fear is still the leader as far as the makeup, the tenor of this market. Fear of recession, fear of the Fed, fear of higher rates, fear of the commercial real estate collapse, fear of consumers putting their wallets and their credit cards away, and on and on. And they say the market climbs a wall of worry. Well, we have a legitimate wall of worry here. I mean, so far though, the market has been amazingly resilient. It's taken a lot of bad news and taken a lot of big shots and still holding up, man. So we'll see if it can continue to do. This yield curve inversion, we've been talking about this since last year when the yield curve inverted. We really believed that was the signal. Recession is here. And it's been inverted for around 18 months, maybe longer now. Now the inversion is starting to straighten out. The longer term rates are starting to come up, shorter term rates not going up as fast, so the inversion was 108 basis points. Now it's down to 32. Now, let's talk about this, okay? When the yield curve straightens itself out and uninverts. That is a big predictor of imminent recession coming. Okay? Now the inversion, that is a signal that recession is coming. Okay? It's not 100% accurate. It doesn't always predict the recession. But the yield curve has been inverted for every recession since the 50s. So it's a pretty good predictor of one coming. It's just not a timing thing. It's a warning, right? Now when the yield curve reinverts, okay, when the yield curve comes back, reinverts, that is, now we go past warning to alarm bells ringing, okay? And I've been telling you, I've been talking about it on the show for a long time, that we are not going to get out of this fight of inflation quickly. We're not going to get out of it easily. We're not going to get out of it painlessly. And I really believe, and still do, we're not going to get out of it without a recession. It's just not going to happen, man. This whole soft landing idea sounds great, wonderful, let's do it. Just never happens. It's a unicorn. It's a myth. It's just, so I really believe we're going to have this recession. I'm not sure if it'll start this year or maybe wait until after the holidays. But we're going to have this recession. There's no doubt about it. Rates now where they are, people really starting to freeze up as far as a mammoth amount of payments to be made. Consumers still adding on, layering on debt, just like everybody else. We're going to have a reckoning with all this debt, especially the debt that can't be paid off and has to be refinanced to these new rates. It's going to, let's face it, man, when you have a payment and a rate at 2% or 3%, your payment reflects that rate. And now you have to refinance that debt after paying down very little principal during the term of that loan. And now you're going to refi from, say, 3 to 7. Well, that's going to make a huge difference in your payment. And most people that have loans have more than one. So now you got multiple payments going up gigantically. People are going to have difficulty making these payments. And even if they can make them, right? Even if they can make the payment, the extra money they're spending on those payments is going to eat up their disposable cash. It's going to limit them in the spending they want to do and have been doing, which is going to slow down the economy, which will lead then, consumers are 70% of the economy. You don't have to be, Sherlock Holmes here to figure out what happens if 70% of the economy decides to take a vacation. Now, I don't know if consumers are smart enough to stop piling debt on. I'd like to think that the people who listen to this show, especially you regulars who've been tuning in every day, I'd like to think you guys have been following our advice here, just very faithfully stashing a little bit here, stashing a little bit there, and not taking on new debt, investing conservatively the way we've been advising, being very choosy in the way you spend your money. The people who've been listening to our advice are doing good. Don't get me wrong, it's still pretty scary out there, but they have more money stashed now than they did. They have less debt now than they did. They haven't had to sweat these scary markets, and if they've been in the market, they've had much smaller losses than most people have, and they've certainly gained nicely when the market rallies, right? Well, now, guys, you can really be really ultra cautious, put your money in a money market, lock in your 5.5%. You're still beating inflation, depending on whose measure you're using. But this yield curve straightening out, it's going to be fascinating to see it. Now we're going to see the 10-year above 5%. It's been a long time. That hasn't happened since before the big kablooey in 2008, the global financial crisis. So changes are coming, guys. And then these changes causing everybody to think very negatively right now. A new poll, the IDP tip poll, shows economic optimism in the United States sitting at a 12-year low. Pessimism rules. The poll sank 6.9 points to 36.3. Anything under 50 reflects pessimism by consumers. Consumers not believing this economy is good, not believing it's going to get better. High rates, everything unaffordable, political uncertainty, dumbasses one after another, leading these parades. But here we sit, guys, a big mess on our hands. Tomorrow's going to be the day, though. Tomorrow we get jobs. Friday we get jobs created. Tomorrow we get jobs lost. Big days coming up. We're going to be looking forward to bringing you guys the news. The markets are going to move these next couple of days, guys, so batten down the hatches. We'll be here tomorrow to bring you guys the news you need. As always, guys, if you like what you're hearing, please hit the like button. It helps us out with the algorithms. It gets our video out in front of some more people, some new people. It gives us a chance to pick up some subscribers. As always, hit me up with your questions and comments. We'll be back tomorrow to bring you the news you need, guys. Till then, take care. Thanks.